Let's talk a little bit about liquidity, right? I mean, this is a positive and a negative, not having the ability to just take money out of the fund willy nilly whenever you want allows the fund managers to do a little bit different things with that money, which may be beneficial to you in the long term. But let's talk about what you see as having, a 10 to 12 year length of time with this money to do with it that you might not be able to do if it were a more liquid investment.
So it's helpful to kind of think about these funds from like the total timeline. And there's a couple different checkpoints. We say 10 to 12 years overall. The first 2 years is where we're actively raising and deploying capital. So we're getting commitments from investors, but then we're deploying those into the portfolio. So building the portfolio from years 0 through 2 or 3. Then usually by about year maybe 4 or 5 is when we start to see certain properties sell. So you might get some liquidity back. If we're selling assets and getting liquidity back, it'll start to kind of chip away, usually from years about 4 through 8, until you've had all your capital returned. And then hopefully if we're performing well, there's plenty of properties in the portfolio, even after you've been made whole on your investment. And that's when we can really start to increase the return profile of the fund if there's a lot of equity still in the fund after we've made investors whole. So to the end investor, it's kind of staggered liquidity as different properties sell. Not every property is going to have a specific timeline that they're all going to follow. So you might experience the liquidity a little bit differently. But to your point, an investor can't just choose to redeem out of this fund. It's longer term in nature, and we think there's a premium to the illiquidity as well.
One thing I'd add to that, sorry, who I just cut off, but real estate is a long-term investment class. And I think people got a little bit spoiled in the golden years of, the late teens to the early 2020s, where you could hold an asset for 2 years and see significant appreciation. But the truth is, taking a longer-term view in real estate is a more prudent way to invest. And our fund life cycle allows us to do that. There are still deals, as Steve mentioned, where we can execute quickly and create value quickly. But as a whole fund, we need to make sure we have the right amount of time to deliver on whatever the business plan is for an asset.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.